This event means a lot to me because this was my first event 1 year ago when I started as executive director. I see a lot of friendly faces in the room. Membership. Thank you for your membership. Thank you for coming today to hear about the state of the market, some of the opportunities there are, and we've assembled a great panel for you of folks who are going to inform you some of the opportunities that are out there in the real estate market. We have Bestreich from Bestreich Realty Group. I always butcher his last name. I apologize, Derek. James Eisenberg from Urban American, Todd Phillips from Capital One, and Peter Bondere from New York Multifamily Markets and Millichap. So, Chip, one of the things we do well is provide programs such as this throughout the year. One way we do that is from the financial support of organizations like Capital One, but also through members and the support of our membership. And so we can't do that without members. And the best way to do that is to join. We're always looking for new members. What we do on your behalf is lobby in Albany, lobby at the City Hall. I go on podcasts to talk about the need to fight back against the regulatory environment. We have a great staff. John puts together events like this. We have Donald and Joe in our office who do extensive legal research and help our members with compliance. We have Andrew, who's not here, unfortunately. We have Michael, who works on press for us in the office. But collectively, we work very hard to represent small building owners in New York at a time when small building owners need it the most. And you know this better than most of us who aren't owners, but brokers and owners collectively know what is happening, what's been happening for some time, and the importance of working together and banding together as a family in real estate, and collectively joining to push back on what's happening both at City Hall and in Albany. So with your help and with your support, hopefully collectively we can continue to provide programs such as this. We can continue to push back against the rhetoric that New York is closed for business when it isn't, and it shouldn't be, and it should be a beacon for business and for housing across the state, country, and the world. And with your help, we can show that New York can still be open for business. So with your help, we can do that. So thank you so much for coming today. Joe, are you going to moderate this fine program? Sure. Perfect. Thank you so much. Thanks for coming.
Thank you, Jay. Thank you, everyone, for joining us on this wonderful Wednesday morning. Jay pretty much took care of all the introductory stuff. So I think we'll just get started.
I'll do it over there, so I'm going to move.
Good morning, everyone. I'm Peter Bondere, and Chip 2020, build, buy, sell, or hold. There we go. This is a picture of Ray Dalio, and he's the guy who founded a hedge fund called Bridgewater Associates, the biggest and most successful hedge fund ever started in history. And he has a quote that I thought was applicable to start this year, and he says, knowing how to deal with what you don't know is much more important than anything you do know. And I was thinking about when I gave this talk last year, and there was a lot that we didn't know last year, but we weren't discounting it correctly, right? We didn't know what was going to change in our industry, and things changed massively. We did a survey after the rent laws changed, and 90% of the owners, the multifamily owners in New York that we surveyed, responded that the laws changed in ways that were much worse than what they expected. So part of what I'm going to try to deliver you all today is market information that is up to date. Since June 15th, we've signed 35 contracts on New York multifamily buildings, and we're going to use that data as pricing, because probably the biggest question I get right now is what are prices since the laws have changed. These are the cap rates on an average basis. The market has become very nuanced in terms of pricing buildings, and so the averages are a little misleading. But in Manhattan, of those 35 buildings, about a little bit over 4.5 cap rate. Brooklyn 5 cap rate. Queens in the 4s. Bronx higher 5s, and the average across New York City is a 5. Broken out. The other question that we get a lot is how is velocity changed? And what's interesting when we look at these numbers is that at the lower ends of the market, velocity hasn't changed as much as it has at the upper ends of the market. And depending on how you categorize the numbers, it's down anywhere from 50 to 60% in terms of the numbers of transactions. Wow. Looking ahead, I think that now that the adjustment of pricing has occurred and the market is starting to find alignment, we expect that there will be more transactions this year. So I wanted to put out a few examples of some transactions that occurred so we could dig into them a little bit. This was the Kestenbaum family portfolio. There have been a few portfolios that have traded over the past several months. These were mainly in Queens, 539 units. This traded at a 5 cap. All stabilized. This is a building on Greenpoint Avenue, 96% free market that traded at a 5.5 cap. And we sold this, we closed it about 2.5 weeks ago. I think this is interesting because in the slide right before you had a portfolio of buildings that were all stabilized that traded right around a 5, and now you have a free market building here that's trading right at a 5. And they're trading at similar cap rates, but for different reasons. Things in the free market world, such as where the taxes are very important now. In the stabilized world, if we were selling a building and the boiler and roof needed to be replaced, the buyer would be happy about that. They would look at those items, say we're going to do MCIs, we'll make those repairs, we don't even have to worry about that. It didn't impact the sale. Today, if you are selling a building and you're stabilized and you have those items, the cost of those items is coming off the purchase price. Another nuance. This is a building that we put under contract a couple months ago on East 19th Street. So here you are in Manhattan, 70% free market, 30% stabilized, but it's still traded in the 3 cap range. So the buildings, the neighborhoods, the streets, they're all playing out differently in terms of the sales today and pricing. The other question is who's buying? There are a whole new set of buyers in the market today, but this slide is what I think is probably the biggest motivation of why people are buying today. And this is the spread between cap rates and treasury rates. So essentially the profit on your leverage. And you can see when these gaps are wide, those have typically indicated the best buying opportunities in the market. The last one being coming out of the Great Recession, 2010, 2011. And you can see this year it started to widen again as interest rates drop and cap rates have come up. So I can't predict the future, but this slide indicates today's a buying opportunity. So just quickly to outline what I'm going to put out today, today's topics. I think there are 5 things that we know about 2020. There are 3 unknowns. And whether you should build, buy, sell, or hold, I'm going to give you 5 questions to ask yourself. So what are the 5 knowns in 2020? I think we have we have the federal election, right? We had the Democratic debate last night. This is going to impact business sentiment. I think it's also going to impact interest rates this year. Right? So you have Trump's and the 4Bs, Biden, Bloomberg, Bernie, Buttigieg, and Warren. It's a mouthful, right? Who's it going to be? Good cause eviction bill. Jay was on my podcast last month, and we talked about this. I think if this is voted on, how it's implemented will have massive impacts on our industry coming up this year. The other thing, looking ahead to 2020, the rent guideline board vote that happens in June. If you're buying a stabilized building and you're buying it at a 5.5 cap, and the guidelines give us a 4% increase, that's going to impact the industry much differently than if you get a 1% increase. If you get 4% increases compounded when you're buying at a 5.5 cap, these all of a sudden look like great purchases. So I think how this plays out is going to be very indicative about our industry going forward. This is a look back at some of the increases. You can see coming out of the recession, we did get some very bigger increases compared to 2015, right when de Blasio started to take office. We had a couple of years of 0 increases. Interest rates have been very impactful this year. From our perspective and speaking with owners, had interest rates not dropped in 2019 like they did, you would have seen a lot more distress in the marketplace. New buyer formation. And another question that we get all the time is who's buying. We've noticed that about 40% of our Manhattan buyers that bought properties in the second half of the year were new to market buyers. So there is new capital that is reading the press and looking at what's happening in New York and seeing it as an opportunity. I think a lot of this has to do with their projections of how long they plan to hold the assets. So what are the 3 unknowns in 2020? Bank loans, bank loan amounts, and loan to values. The law impacted, the change in the law impacted the business, not as much that we have distress in cash flows, as many of you guys know, but we do have, if you valued every property today based on what has sold so far, you probably have technical defaults around the city and the boroughs. So how the banks act over the next 24 months is going to be something that we need to watch. Insurance rates and operations. Operating costs in almost every category have risen significantly over the last year. Taxes continue to rise. In some of the better Manhattan neighborhoods, we're seeing owners start to receive tax bills that are approaching 30 or in some cases above 30% of your income. So you really have a unwanted partner riding sidecar with you in terms of the city and what they're charging for real estate taxes. This is something that we have to be aware of. The third thing that is unknown in terms of how it will play out this year, but so far it looks like it's good news for owners, that free market rents are starting to rise after 3 or 4 years of having it be more muted, and we're starting to see concessions evaporate. In the past 60 days, we've actually started to see rental increases. So a lot of the marketplace has been looking for when are free market rents are going to rise. The law, in terms of reducing our supply, the supply of free market units coming to market is now starting to play through, and you're going to start seeing free market rents rise. So, should I build, buy, hold, or sell? I think there are 5 questions that you can ask yourself as an owner that will help determine what your answer to that is. So the first is, what's my asset worth? The second is, once you know that, what's my return on my actual equity on the asset? Last year, we sold about $350 million worth of net lease properties. And most of that were New York City owners that were coming to us and having us look at their asset. And when we looked at what their current return on their equity, they were only making 2 or 3% on their money. And when they sold and transitioned to another property type, their cash flow was doubling, in some cases tripling. So should you, in terms of just, these are questions that I think you should ask yourself every year as you evaluate your investments. I think it's interesting, real estate owners don't look at their assets the way people who have a stock portfolio do, where you're looking at a statement every month. And you don't, there's nothing that happens on the calendar that compels real estate owners to look at their assets in these ways on a regular basis. So what's your return on your equity? What's my investment time horizon? We all know that the court case is not going to be something that's going to give us an answer tomorrow. So if you plan on holding your building for 10 years, or if you plan on holding it for 2, 3, or 4 years, depending on that answer is going to inform what your plans are going to be and what your strategy is going to be. How should my management strategy change? James probably has a lot to say about this topic, so I won't take too much of that away, but there's a lot that has to change in your management strategy relative to the law, and we know about that. The fifth question is, what's the lesson that you can apply to your future investments? And I think a way to get out of the muck of the, I think everyone in the industry, we're all in this together, and people are rattled by what happened with the law. But I think you have to look at it, well, what's the lesson? I was at an event yesterday, and someone stood up at the event and they said, the mayor was elected last year in New York City by 400,000 votes. And he said, the last time I researched how many people are in the real estate industry in New York City, he said there's 400,000 people just in the real estate industry. So there are a lot of lessons, I think, that the real estate industry, and that's why we're all here in this room, and Jay mentioned, joining groups like this and contributing and becoming, getting involved. But there's myriad lessons that we can learn from this year, and I think you should ask yourself, what lesson did I learn from last year that I can apply to my future investments? So, this will end it off, but I thought I'd end with this. This is the Declaration of Independence. And Thomas Jefferson got some of his wording for this from philosopher John Locke. And we all know this phrase: life, liberty, and the pursuit of happiness. It was originally written, life, liberty, and the pursuit of property. And Thomas Jefferson changed it at the last minute. I think when you control your property, you're happy, right? So I'll leave you with that, and hopefully that happens to all of you more this year.